Well, it looks like the Federal Reserve is going to cut interest rates this week, and I'm sure that'll make the President of the United States quite happy. Now, of course, the mainstream, who still regard the Federal Reserve as a cabal of wizards of smart, are racking their brains trying to figure out exactly what the Fed is doing, because they know that whatever the Fed does must be very well thought out, and of course the right thing to do. The only question is, why is it the right thing to do? Mainstream analysts seeing unemployment at all-time lows and stocks at all-time highs, and the economy still in the green, growing every quarter. This past quarter, I think 2% thereabouts, 2.1%. And it seems now that the mainstream narrative is that this is what they call an insurance cut, and you can see me using air quotes there. That means that, the Fed thinks, oh, gee, we don't really need to cut rates because things are going so great, but hey, we might as well just cause, which is total nonsense in this case. There is absolutely a reason for the Fed to cut rates, and the reason why the Fed needs to cut rates, in their opinion, is that they think that there's going to be a recession if they don't do anything, if they just stand by and let the market, do as it may. When you blow a big economic bubble, it's going to pop at some point, and the Fed is trying to prevent that. They're trying to pump more air in there because they see that, perhaps there is a bit of a leak. It hasn't popped yet, but there might be a bit of air coming out. And so they've got to keep injecting more and more air into this bubble to keep things going. After all, this is just about, I think it might actually be the record now, the longest economic expansion in American history. And that would mean that we're probably in one of the most fragile states of the economy in American history, because as an economic cycle carries on in an economy which is founded upon a fractional reserve banking system, you end up with piles and piles of malinvestment, and the longer that rates stay low and that the economy keeps clicking along and expanding, your odds of increasing the amount of malinvestment in the overall economy ticks higher and higher. Malinvestment, for those of you who don't know, are essentially bad bets made by entrepreneurs that don't really turn bad until the economy starts to turn, or when interest rates start to rise. These are projects which are not sustainable in the long term, things that will end up going bust when the cycle comes to an end. Of course, we all know that every time there's a recession, there are folks who make it through and there are folks who go bankrupt. Malinvestment is all the stuff that goes bankrupt. And that's why, preferably, if you're going to have this kind of a financial system, you want to have your economic cycles be as short as possible, so therefore your recessions are that much more mild. You don't want the system to just keep loading up on bad debt like this. And when the tables begin to turn and the air starts to come out, the last thing you want to do is try and pump in more air to get people to make more bad bets, to essentially accumulate more bad debt that can't be paid back. Unfortunately for Jerome Powell, however, when he took over as the chairman of the Federal Reserve, things had been already ticking along for way too long. Frankly, Bernanke was too much of a coward to let things really crash in 2008, and so he essentially just sort of swept a lot of bad debt under the rug in the form of quantitative easing, trying to pull all of those bad mortgage-backed securities out of the system. And in doing so, he was able to hide a lot of the pain that otherwise would have been inflicted upon the American economy. And in addition to that, he then decided to pump in a bunch of new money to try and get people down the debt-ridden train again. And the effect of what Bernanke did was essentially to inflate a stock market bubble, a new stock market bubble. This time, there were really two reasons why that occurred. One, with cheaper interest rates, companies which are publicly traded were able to borrow more money to invest back into their companies and grow the value of their company, and therefore boost their shares. And doing that across the whole economy led to a higher stock market. And also, because interest rates were so low, there were very few investment opportunities for folks outside of stocks. So it was there was no other alternative. Stocks were the only game in town if you wanted to make positive real returns. And of course, once the stock market started to recover, then folks became more optimistic about the economy, and they decided to start spending more money and buying cheap plastic toys from China and new television sets and things. And this is what we call prosperity in America. This is what pushes up, the gross domestic product. People just spending more money on useless consumer goods. That is what really boosts presidential popularity. It boosts optimism. It's what makes people feel good. Now, unfortunately, what that means, though, is that all of our so-called prosperity is based on a stock market bubble, meaning that if stocks were to go down, well, then consumer confidence would fall. Folks who own stocks would, see a decline in their net worth, and that would make them not want to spend as much money. And folks would begin to tighten their belts, and you would see less consumption spending every year, and therefore you would see a lower gross domestic product and less of what the mainstream considers to be prosperity. Instead of buying a new TV every year, perhaps people will only buy a new TV when the old one breaks. Instead of a family of three living in a 3,000 square foot house, they may only live in an 1,800 square foot house. And this is Jerome Powell's worst nightmare. It'll look like he, as the Fed chairman, was unable to keep the economy going. It will look like he brought about a recession. And of course, as the central bank chief, he doesn't want that on his shoulders, because people will look back and say, look, Bernanke and Yellen got us through, a decade without any recession. And then Jerome Powell comes in and we have a recession. It must be his fault. Because, of course, the general public doesn't really understand that, recessions happen for other reasons that are rather complicated. And, of course, if there's a recession, the President of the United States certainly will pin it on Jerome Powell, even though it's not really something that Jerome Powell or President Trump had the power to prevent. That aside, though, Jerome Powell feels like it is his mission, his duty, to do everything he can to prevent this recession from happening, or rather, to stave it off for as long as possible. That is why the Fed will cut rates this week, although I'm still undecided on whether or not it will be 25 or 50. I was leaning towards 50 the last time I spoke on this topic, a 50 basis point cut, meaning a half a percentage point, because a 25 basis point cut is already baked into the cake. And if Powell's goal is to boost the stock market, well, then he's going to need to surprise the market. He's not going to want to just do what the market's expecting. He wants to lead. He doesn't want to follow. I mean, if his goal, like his predecessors, is to manipulate asset prices, he's going to have to screw with them a bit, psychologically. And that's why, despite all the telegraphing suggesting that there's going to be a 25 basis point cut, I'm still thinking that there very well might be a 50 basis point cut, if that is indeed Powell's goal. Because, of course, if his goal was to surprise the market, he would not signal a 50 basis point rate cut ahead of actually announcing it. Ultimately, however, Powell's efforts will have been in vain, because the Fed cutting rates has really never prevented a recession. It has only perhaps pushed it off, or in the case of 2007, it didn't even really do that for very long. And of course, Zero Hedge posted up an article, cherry picking, albeit quite a few economic indicators, which are worse now than they were in the year 2007, when the Fed cut 50 basis points into that last recession. So if you gained anything of value out of this video, I'd appreciate you clicking that like button and subscribing. And if you do subscribe, please do click the bell, because I do upload every day, and I'd hate to have you miss one. So I'll see you folks back here tomorrow.